The financial world rarely moves in silence, and when it does, the echoes that follow can reshape the foundations of global capital. In recent months, a transformation has been unfolding within the corridors of the world's largest asset manager, a shift so substantial that it demands our attention not for its sensational headlines, but for what it reveals about the fundamental currents moving beneath the surface of modern finance. BlackRock, the institution that manages assets exceeding the gross domestic product of all but a handful of nations, has been systematically repositioning trillions of dollars away from traditional American holdings and toward investments scattered across continents and asset classes that would have seemed inconceivable to investors just a generation ago. This is not a story about conspiracy or collapse, but rather about the quiet recalibration of capital in an era where the rules governing money, power, and economic geography are being rewritten in real time. To understand what this movement signifies, we must resist the temptation to view it through the narrow lens of quarterly earnings reports or market fluctuations. Instead, we need to step back and examine the longer arc of capital migration, the historical precedents that illuminate our present moment, and the structural forces that compel even the most powerful financial institutions to adapt or risk obsolescence. The magnitude of this reallocation cannot be overstated. When we speak of $2 trillion moving across borders and asset classes, we are describing a sum larger than the entire economy of Italy, larger than the combined wealth of dozens of nations. But numbers alone tell us little. What matters is the pattern they reveal, the logic behind the decisions, and the vision of the future that such movements imply. BlackRock's leadership has not made these choices impulsively. They represent a calculated response to a convergence of forces that have been building for decades, forces that are now reaching a critical threshold. To truly grasp the significance of this moment, we must journey backward through time to another era of great capital transformation, a period when the dominant financial power of the age began to recognize that the world it had shaped was evolving beyond its control. In the late 19th century, Britain stood as the undisputed center of global finance. London was not merely a city, but the beating heart of international capital, the place where money from every corner of the empire and beyond flowed to be allocated, invested, and multiplied. British institutions managed the infrastructure of distant continents, financed the railroads that carved through virgin territories, and underwrote the Industrial Revolution that was transforming human civilization. Yet even as Britain reached the apex of its financial dominance, astute observers could detect the first tremors of a coming shift. The rise of American industrial capacity, the emergence of Germany as a manufacturing powerhouse, and the gradual development of financial centers in other parts of the world, signaled that the unipolar world of British capital supremacy would not endure forever. The process was not sudden. It unfolded across generations, through 2 world wars, through the slow erosion of colonial systems, and through the steady transfer of economic vitality from old centers to new frontiers. British investors, facing declining returns at home and explosive growth abroad, began the long process of reallocating their capital to more promising venues. This was not defeatism, but pragmatism, the recognition that capital must flow where it can grow, regardless of national sentiment or historical loyalty. The parallels to our present moment are striking, though not exact. America in the 21st century is not Britain in the early 20th. The United States remains the largest economy on Earth, the issuer of the world's reserve currency, and home to the most innovative technology companies in human history. Yet the landscape is shifting. Growth rates in emerging markets have consistently outpaced those in developed economies for decades. The demographic profile of the United States, like that of Europe and Japan, points toward aging populations and slower expansion, while younger, more dynamic societies in Asia, Africa, and Latin America are beginning to claim their share of global economic activity. The yields available in American markets, suppressed by years of unconventional monetary policy, have pushed investors to seek opportunities in regions where risk and reward calculations look markedly different. BlackRock's repositioning reflects this new geography of opportunity. The firm has been increasing its exposure to Asian markets, particularly in infrastructure projects that will define the economic landscape of the coming century. It has expanded its holdings in renewable energy assets across multiple continents, betting that the transition away from fossil fuels will create wealth on a scale comparable to the industrial revolutions of the past. It has moved capital into private markets, away from the publicly traded equities that have traditionally dominated American portfolios, seeking the higher returns and lower correlation that alternative investments can provide, and it has embraced emerging market debt, recognizing that the next generation of sovereign borrowers may offer yields that developed nations, constrained by their own debt burdens, can no longer match. To understand why this is happening now, we must examine the mechanics of the global financial system and the structural changes that have made such massive reallocations both possible and necessary. The architecture of modern finance rests on several pillars that have been fundamentally altered in recent years. First among these is the regime of interest rates that has prevailed since the financial crisis of 2008. Central banks in developed economies, desperate to stimulate growth and prevent deflation, drove rates to historic lows and held them there for over a decade. This had the intended effect of encouraging borrowing and spending, but it also had unintended consequences for investors seeking income from fixed-income securities. When a 10-year United States Treasury bond yields less than 2%, institutional investors with obligations to pensioners, insurance policyholders, and other beneficiaries must look elsewhere to meet their return targets. This search for yield has been one of the defining features of the past 15 years, pushing capital into riskier assets, into longer-duration bonds, and increasingly into foreign markets, where central banks have not pursued the same aggressive easing policies. The Federal Reserve's more recent attempts to normalize rates have created volatility, but have not fundamentally altered the calculus for large asset managers. The structural need for diversification and higher returns persists, and in many cases has intensified, as demographic trends place greater demands on pension systems and retirement savings. The second pillar is the changing nature of global trade and investment flows. For much of the post-war period, capital moved in relatively predictable patterns, from developed economies seeking returns in emerging markets, and from surplus nations reinvesting their trade earnings in the securities of deficit nations, particularly the United States. This arrangement, sometimes called Bretton Woods II, created a stable if imbalanced system in which American consumers borrowed and spent, Asian manufacturers produced and saved, and financial intermediaries recycled the resulting surpluses. But this system has been fraying for years. China's economy has matured beyond its role as mere workshop to the world, developing sophisticated domestic capital markets and pursuing a strategy of international investment that rivals anything attempted by Western institutions. Other emerging economies have followed similar paths, building their own financial infrastructure and reducing their dependence on dollar-denominated assets. The result is a world where capital flows are more multipolar, more complex, and less dominated by any single nation or currency. BlackRock's reallocation is both a response to this new reality and a contribution to it. By diversifying away from dollar assets and American markets, the firm is acknowledging that the future of wealth creation will be distributed across a broader set of geographies and currencies than at any time in modern history. This is not a rejection of America, but a recognition of mathematical reality. If the United States represents roughly a quarter of global economic output, then a portfolio heavily concentrated in American assets is by definition making a bet that American exceptionalism will continue to outweigh the advantages of global diversification. For an institution managing money on behalf of millions of individuals and thousands of institutions, such a bet becomes increasingly difficult to justify. The third structural change involves the evolution of the assets themselves. Traditional portfolios were built around stocks and bonds, with perhaps a small allocation to real estate or commodities. But the universe of investable assets has expanded dramatically. Private equity, venture capital, hedge funds, infrastructure, timberland, farmland, intellectual property, digital assets, and countless other categories now compete for institutional capital. Many of these alternatives offer characteristics that traditional public markets cannot match. They provide access to companies and projects before they reach the public markets, capturing value that would otherwise accrue to founders and early backers. They offer lower correlation to broad market movements, potentially reducing portfolio volatility, and they allow investors to participate directly in long-term trends like urbanization, technological disruption, and resource scarcity that may not be efficiently priced in liquid markets. BlackRock has been at the forefront of this expansion into alternatives, building out capabilities in private markets and encouraging clients to increase their allocations to these strategies. The movement of capital out of traditional American stocks and bonds is in part a movement into these newer asset classes, many of which are inherently global in nature. When BlackRock invests in infrastructure projects in Southeast Asia or renewable energy installations in Latin America, it is not making a statement about American decline, but rather pursuing opportunities that simply do not exist in mature, developed markets where most infrastructure is already built and most obvious efficiencies have been captured. History teaches us that these transitions are neither smooth nor predictable in their ultimate effects. The shift of financial dominance from Amsterdam to London to New York did not follow a linear path. Each transition was marked by crises, wars, technological revolutions, and social transformations that no contemporary observer could have fully anticipated. The movement of British capital out of Britain in the late 19th and early 20th centuries did not impoverish the nation overnight. But it did mark the beginning of a long relative decline in which Britain remained wealthy, but ceased to be the unquestioned center of global finance. Similarly, the diversification of capital away from concentrated positions in American assets does not presage imminent collapse, but it does suggest a future in which American financial dominance is less absolute, less taken for granted, and more dependent on continued innovation and adaptation. For individuals trying to make sense of these macro-level movements, the implications are both profound and subtle. The reallocation of institutional capital affects the prices of assets, the availability of financing for businesses, the returns available to savers, and ultimately, the distribution of wealth and opportunity within societies. When trillions of dollars shift from one set of investments to another, it creates winners and losers, not through any malicious intent, but through the impersonal logic of markets seeking equilibrium. Companies that lose access to cheap capital may struggle to expand or may face higher costs of borrowing. Regions that attract new investment flows may experience economic revitalization, while those that see capital depart may find growth harder to sustain. Workers whose skills are complementary to the new patterns of investment may find their labor more valuable, while those tied to legacy industries or geographies may face headwinds, yet we must be careful not to overstate the speed or severity of these changes. The global financial system moves with great inertia. The dollar remains the world's reserve currency, backed by the deepest and most liquid capital markets ever created, by a legal system that generally protects property rights, and by military and diplomatic power that extends across the globe. American technology companies continue to dominate the digital economy, generating profits and innovation that attract capital from every corner of the world. The institutions of American finance, including BlackRock itself, remain headquartered in the United States and deeply enmeshed in the American economy. What we are witnessing is not an exodus, but a rebalancing, a recognition that the world economy has evolved beyond the configurations of the mid-20th century, and that investment strategies must evolve accordingly. The philosophical question underlying all of this is what we mean by capital and where it truly belongs. In an age of digital finance, where money can move across continents in microseconds, the notion of capital having a national home becomes increasingly abstract. BlackRock manages assets on behalf of investors from dozens of countries, investing in opportunities across hundreds of markets. To describe this as moving capital out of America is in some sense to impose a framework that may not capture the reality of modern finance. The capital was never purely American to begin with, and its deployment in global markets serves the interests of the ultimate beneficiaries, whether they are American pensioners, European insurance companies, or sovereign wealth funds from the Middle East. The firm's fiduciary duty is to generate returns within acceptable risk parameters, not to serve any particular national agenda. This raises uncomfortable questions about the relationship between finance and sovereignty, between the imperatives of capital and the needs of communities. When the largest pools of money in the world are managed by institutions that operate on a global scale and answer to shareholders and clients rather than to any particular electorate, the potential for conflicts between financial logic and social welfare becomes acute. A factory closure that makes perfect sense from a capital allocation perspective can devastate a town. A shift in investment strategy that enhances portfolio returns can drain resources from public markets and reduce the funding available for small businesses and local governments. These tensions are not new, but they intensify as the scale of capital under management grows and as the mobility of that capital increases. The historical record offers both cautionary tales and reasons for measured optimism. The great capital reallocations of the past did contribute to painful adjustments and to the displacement of workers and communities. But they also helped to finance the development of entire continents, to spread technology and knowledge across borders, and to create opportunities for hundreds of millions of people to escape poverty. The British capital that flowed into American railroads in the 19th century built infrastructure that transformed a young nation into an industrial powerhouse. The American capital that flowed into post-war Europe and Japan helped to reconstruct shattered economies and build the foundations for decades of prosperity. The challenge is to ensure that the current wave of capital reallocation serves similarly constructive purposes and that the benefits are broadly shared rather than narrowly concentrated. Looking forward, several trends seem likely to accelerate. The demographic divergence between aging developed economies and youthful emerging markets will continue to drive capital toward regions with more favorable growth prospects. The transition to renewable energy and sustainable infrastructure will require investments on a scale that dwarfs anything yet attempted, creating opportunities for investors who position themselves early. The digitization of finance will continue to erode the advantages of traditional financial centers, allowing capital to flow more freely to wherever opportunities emerge. And the rise of new technologies, from artificial intelligence to biotechnology to advanced manufacturing, will create winner-take-all dynamics in which the first movers and the best capitalized will capture disproportionate shares of the value created. For institutions like BlackRock, these trends represent both opportunities and responsibilities. The power to allocate trillions of dollars carries with it an implicit obligation to consider not just financial returns, but also the broader consequences of investment decisions. This is not a call for charity or for the subordination of fiduciary duty to political agendas. Rather, it is a recognition that long-term value creation depends on sustainable economic systems, on functional institutions, and on social stability. An investment strategy that maximizes short-term returns while undermining the foundations of prosperity is ultimately self-defeating. The challenge is to find the balance, to pursue returns while also contributing to the kinds of economies and societies in which capital can continue to grow over generations. As we contemplate what these shifts mean for the future, it is worth remembering that the purpose of finance is not simply to enrich those who already have capital, but to serve as an engine of human progress. At its best, finance connects those with resources to those with ideas, channels savings toward productive uses, manages risks that would otherwise paralyze economic activity, and creates the infrastructure of trust and accountability that allows strangers to cooperate for mutual benefit. The movement of capital across borders and asset classes can fulfill these functions if it is guided by wisdom as well as by calculation, by an understanding of history as well as by models of the future, and by a commitment to shared prosperity as well as by the pursuit of individual gain. The story of BlackRock's reallocation is ultimately a story about adaptation in an age of transformation. It reminds us that the structures we build are never permanent, that the dominant positions we establish are always subject to challenge, and that the future will inevitably differ from the past in ways we cannot fully predict. What we can do is study the patterns, understand the mechanisms, and prepare ourselves for a world in which capital is more mobile, more global, and more diversified than ever before. This is neither a cause for celebration nor for despair, but simply the reality we must navigate with intelligence, with humility, and with a clear-eyed recognition that the chronicles of capital are still being written, and that the next chapter is just beginning to unfold.